Say good morning. It's noontime here in Doha, 1 o'clock in Dubai, where Alex is, and I guess it makes it 9 a.m. Rakesh in the UK. So again, thank you all for joining. We obviously had scheduled to do this event this time last week, but as a result of recent instances in the Middle East, we decided to postpone for 1 week. But I think we really felt, as one of our panelists said to me earlier today, the show must go on. I couldn't agree more. And particularly as we're actually looking at UK property, and we're looking at UK property, looking at different options available, looking at some of the tax issues and other things that surround that market. I'll just put a personal plug in. I'm a Canadian national, but I've lived in the UK on two separate occasions, and myself have investment property in the UK, so I'm always very bullish on the UK. Certainly, I was going to say on the long term, but long term, medium, and short term. Frankly, I think it's an excellent market for investment, and always like to recommend it to people. What I'm going to do is I'll basically host our event today. I'm the co-founder, along with Alexander Hartman, of Society International Real Estate. The genesis of the idea was Alexander's, and he very kindly brought me into the company at the beginning. So I'm very happy to be part of the team. So I'm going to first introduce Alex. Alex Payani is going to speak to us about opportunities. Alex, I'll let you do your full introduction so I don't sell you short. Give you a good chance to talk about yourself, your company, and different opportunities that you want to share with us today.
Perfect. Thank you, Jeffrey. Alex, did you just want to share the presentation? Obviously, I can begin sort of allowing to visualize it for the audience. But yeah, in the meantime, whilst that's being shared, just obviously thank you to Alex and Jeffrey for setting this up and inviting API Global to speak. Perfect. So before I let me just make my screen maximize it. So before I get into I guess the current UK landscape, I'd like to just sort of briefly explain how we work at API Global, and I guess how we collaborate with partners such as Society International to present investment opportunities to clients globally. So with API Global, over the past 14 years of operating as a business, we have finessed a process that allows us to partner with property advisories, partner with wealth managers around the world, and ultimately give investors looking to build and hone a UK property portfolio very much a hands-off, hassle-free approach. So irrespective of where you're based, you know your portfolio is being managed correctly by ourselves and partners such as Society International. Okay. Now, with our process that's been fine-tuned over the past 10 plus years, everything that we do begins with our research and strategy team that's based out of the UK. So we have an office in London, an office in Manchester, which is where we offer a lot of our developments. Now, the team in the UK, it's ultimately their responsibility to identify what we believe to be the UK's next growth corridors. And by analysing and identifying these new pockets of growth, to come to that sort of conclusion as to what we feel to be the right investment, it's very much based on factors including, population growth, infrastructure investment, employment centres and regeneration zones across the UK, not just London, but also regionally as well. And I think importantly, at API Global, we don't just target new areas in the UK to offer to clients simply just to increase our footprint. We focus on cities where we see clear long-term investment fundamentals and strong demand drivers. So I guess in many ways, API Global operates as a research-led organization first, ensuring that the locations and developments that we bring to market are backed by real data and genuine demand. And then once the location and development has been identified, we then sort of move to step 2, which you can see on your screen now, which is all around the security and the due diligence that is conducted on developers and also development. So every project that API Global will introduce to Society International and subsequently the clients, it goes through an extensive due diligence process. So Each development is subjected to a 120-point checklist, which is then reviewed alongside external conveyancing partners before it's then even introduced to partners and clients. And the goal, I guess, with that due diligence mindset is to ensure that opportunities that are presented, they stack up financially, but also structurally, whether it's contracts, timelines, pricing, so that investors can then move forward with confidence, which is important. Okay. Once a project is ready and due diligence has been successfully conducted, we then move to point 3, which is the investment advice. This is where our partners, such as Society International, this is where they come in. We work very closely alongside Society International to present opportunities to their clients, and that can be through seminars, through webinars such as today, or through private briefings when there are specific projects that we want to work alongside them on and get a number of individuals in a room and really double down on a specific project. Okay. Then from points 4 onwards, once a sale has been done, once we've sort of had the chance to meet with investors and understand the strategy of that investor and then sort of positioned the right project, beyond that initial purchase, the support will then continue with API Global through our sales progression teams. These client service teams we have based across the Middle East and the UK. And ultimately, it's the job of sales progression to guide investors through the entire acquisition process. So that can include introductions to solicitors, just to make sure contracts stack up, but also keeping clients informed during those off-plan projects. It's pointless an investor investing, let's say, £50,000 sterling, if they're not kept abreast as to how that project is being constructed and ultimately seeing how that capital is being worked for them. So we make a proactive point of every quarter, we send construction updates to our partners to pass on to clients. So again, they're continued to be given that confidence that their money is being worked for them. And as we all know with UK property, a lot of that initial capital growth we see happens during the build phase. So it's very important that clients are kept updated with that build progression. And then once the property is complete, API Global and preferred partners are on hand to support, be it via financing, lettings management, and of course, portfolio optimization. And portfolio optimization is pivotal because we look at working with clients who are investing for the first time as very much being the start of that journey. How can we support clients build that multi-unit portfolio, diversifying across markets such as Qatar, UK, and further afield? And it's our job to work alongside Alexander and Jeffrey and the clients to make sure that we're always looking at those ways of enhancing a return on investment across that full portfolio. So for us, it's not just one transaction, a handshake and all the best. That's very much the start of the journey, and how can we build that portfolio over a 5, 10, 15, 20 year time period. Okay. Alex, would you kindly please move to the next slide? Thank you. So now turning to the UK market itself, and I guess why API Global for the past 14, 15 years has had confidence in the market, but also why we believe that 2026 and beyond is looking particularly encouraging for investors. I just want to touch upon a number of points here. Firstly, the UK remains one of the most stable and transparent real estate markets in the world. I think for international investors, particularly those based in the Middle East, stability and legal protection are extremely important, especially when we consider sort of what is ongoing in the region at the moment. The UK offers both, which is why it's remained a core destination for global property investment for many decades, and I think many decades to come as well. Secondly, the UK market, the UK residential market, is well established and highly resilient. Even during periods of global uncertainty, property in major UK cities such as your Londons, your Birminghams, your Manchesters continues to demonstrate strong long-term performance. The third factor is that interest rates are seemingly beginning to stabilize. So over the past couple of years, interest rates have increased globally, which unfortunately does sometimes slow property transactions. I guess as inflation begins to ease, borrowing conditions are improving, and this historically marks the beginning of what we believe to be that next property cycle in the UK. The fourth factor, which again has been ongoing now for a number of years, is just the increase in a supply-demand imbalance in the UK. The UK faces and continues to face a significant housing shortage. So therefore, with demand for housing consistently outpacing the number of new homes being delivered each year, what this does is that this imbalance naturally supports both rental demand, but also long-term property value for investors, short-term and long-term, okay? The fifth point is strong rental demand and yields. So again, cities, your regional cities such as Manchester, such as Birmingham, we're now seeing it more in these growth corridors in zone 3, zone 4, zone 5 London, continue to experience strong tenant demands, driven by the factors I've mentioned, population growth, young professionals, international students, corporate behaviours, so on and so forth. And then finally, capital growth. Many analysts believe the UK market is now entering the early stages of the next property cycle. Historically, investing during the stabilisation phase has proven to be one of the most attractive entry points for long-term investors. Okay, so that's why API Global, and I'm sure that the guys on the webinar will also resonate, we are quietly bullish about this year and beyond about the UK market. And what that brings me nicely on to, Alex, if you can move to the next slide, is I'm just going to share a couple of opportunities that API Global are exclusively working on now in the UK. I'll start with London. I will start with Claremont Quarter. So London remains for us one of the most internationally recognised property markets in the world. It's a global financial centre, a major education hub, and continues to attract both international talent, but also capital. The development that I'm highlighting here is Claremont Quarter, which is located in Cricklewood in North London. It's an NW2 postcode. And I think for me that the major driver of this particular investment is that it sits nicely within the Brent Cross regeneration zone, which is one of Europe's largest ongoing regeneration projects. The wider regeneration represents approximately £8 billion worth of investment. And with that, it will deliver new homes, retail space, infrastructure, and importantly, employment hubs. The development itself consists of 251 apartments across 3 residential blocks, offering 1 beds, 2 beds, and 3 bedroom apartments. And again, when we look at the connectivity, which again is a massive factor for any driver of growth in the UK, the development itself is located just 500 metres from Cricklewood Station. Cricklewood Station sits on the Thameslink line, where you can reach locations such as Euston and King's Cross in under 15 minutes. So you're paying zone 3 prices with zone 1 connectivity. So for investors looking at exposure to London, regeneration-led opportunities such as this often provide strong long-term capital appreciation. And I think, as you can see on your screen, Claremont Quarter was actually the most sold development in London in Q3 and Q4 of 2025, which just illustrates the appetite of investors, not just looking at London, but looking at this particular part of London where there is a lot of macroeconomic factors in place to drive a strong investment. Okay, so that's London. Alex, if we can move on to Boulevard and Origin, which is... Sorry, 1 second. Sorry about that. Just bring up my screen again. Sorry, I've got a WhatsApp call. So that's annoyingly taking me off my screen. There we go. So just moving to Birmingham, which obviously for many is known as the UK's second city. So Birmingham has undergone significant transformation in recent years. Again, supported by major infrastructure investment and continued growth in employment and in population. The developments we're presenting here, Boulevard Origin, which form part of the same master plan, is located in the South Side district of Birmingham. South Side, for those who don't know the city very well, is known as one of the most vibrant areas of Birmingham, offering a real nice blend of culture, restaurants and entertainment venues. And this makes it particularly attractive to young professionals and renters, which obviously is a huge pool of tenants when we look at a city such as Birmingham. The development itself consists of close to 250 apartments split across both Boulevard and Origin. And again, it's designed to appeal to that growing Birmingham rental market. I guess one particularly attractive element with this opportunity is that the developer incentive is, as you can see on your screen, is covering the cost of the stamp duty for every investor. Now, a lot of people look at that and may think, well, why would a developer do that? That sort of sings or kind of, speaks alarm bells. They want to really get rid of these units. The purpose behind the developer offering such an attractive incentive is that they are now looking to fund their next UK project, which is in Bristol. And with that in mind, they obviously need the appropriate amount of capital, the appropriate amount of liquid to now begin the build phase of their next project in Bristol. So with Boulevard Origin being complete, the units are ready to move in. We have already done the tenant sourcing. So tenants are there ready, waiting to move in. So again, we've kind of done a lot of the work so that once a unit has been purchased and exchanged, it is capital from day one, okay, which I think is a huge incentive for a lot of investors looking for cash immediately, and therefore this is a great opportunity. And then finally, Alex, if we can just move on to Manchester, which for many is seen as one of the fastest growing markets in the UK and has been now for a number of years. Manchester consistently ranks as one of the strongest cities in the UK for both rental growth, but also for capital appreciation. The opportunity that we're highlighting here on our screen is the W residence, which forms part of the landmark St Michael's development, which is located pretty much bang in the city centre between Deansgate and Spinningfields. So for those who are familiar with Manchester, they'll know those locations, but that is the heartbeat of the city, where you've got a lot of your big corporate companies, Amazon, Google, Microsoft, so on and so forth, located and continuing to grow their presence. The development itself combines very much luxury residency with a 5-star W hotel, giving residents access to hotel-style services, including concierge, wellness facilities, co-working space, gymnasiums, which is now a very important factor for tenants, because if you're living in a residency that offers co-working, offers gymnasium, it's going to save you money having to go and buy a gym membership elsewhere, or having to go and get a membership at a WeWork or a Regis or something like that. So having these amenities now not only is paramount for tenants, but as an investor, it allows you to drive a stronger rental premium because you've got a development offering such amenities, okay? Manchester itself continues to attract investors because of the strong fundamentals. The city has one of the youngest populations in the UK and has been ranked by JLL as one of the strongest cities for both rental but also capital growth forecasts over the coming years. So for investors seeking exposure to one of the UK's fastest growing cities, Manchester presents a very, very compelling opportunity. And on the topic of branded residence on the W, Alex, if you can please move to the next slide, because we're very excited to be launching something new in Manchester over the coming months, which is the Nobu residence. So again, Nobu residence, for those who are aware of the brand, it's seen as many as being kind of in that top tier when we look at sort of branded premium opportunities. So branded residences, I guess, especially in the Middle East, has become one of sort of the fastest growing sectors in global real estate, because it combines luxury living with world-class service, but also that global brand recognition. Now, in the UK, the concept of branded residences is still what we believe to be a novelty. So it's kind of really, it's coming into that kind of early phase, as opposed to somewhere like the UAE, where I'm based. Branded residences have been popping up now for a number of years. So in the UK, there's huge value there, because not only obviously do we have the historical data of the UK, but we're now bringing in some of the biggest brand names in the world. And again, developments associated with brands such as Nobu often achieve stronger resale values, but also it does attract significant international buyer demand. And we saw that when we launched the W residence, the overseas interest was vast. So we're very bullish again when Nobu does come to market. So for investors looking at more of a premium opportunity in the UK, this is certainly one to keep an eye on in the coming months. And of course, when we do launch it, we'll be informing Alexander and Jeffrey from day one so they can begin to circulate the relevant material and information for those that are interested in. So I think just kind of to, I guess, a closing note from my side, but I guess when we step back and I guess look at the UK residential market today, I think the combination of stability, strong fundamentals, and improving market conditions, it continues to create a very compelling opportunity for international investors. And I think through API Global's partnership with Society, we're pleased to bring those opportunities I've shared, but again, many more to come this year and beyond, including Nobu. So yeah, watch your space. Again, Alex, Jeffrey, thank you for allowing me to present, and I will pass back to Jeffrey. So thank you very much.
Thank you, Alex, and our pleasure for having you. So I was really intrigued when you mentioned you like to have, you look at customers not just to sell one property, but have a lifetime journey with them. Obviously, I didn't give you a chance to prepare for this, but if I may kind of put you on the spot, give me a little story, maybe one of your investors who you've seen kind of start at, kind of like maybe like crawling stage to walking to building a portfolio. Just give me an idea of somebody you've worked with over the years. I'm actually particularly interested in this.
Yeah, I mean, I guess the benefit of API Global working with partners such as yourselves, but also in the wealth management space, there's always that mindset of the long-term goal here is to build a portfolio. So to give you kind of one of many examples, we will have some investors who their first investment could be as little as £200,000 to £250,000 as a property value. Now, obviously, as we always look to encourage investors is look at the mortgage options, look how much we can leverage from a finance perspective. If we can put in as little as, let's say, 25% and then leverage up to 75%, that puts us in a position that typically we review portfolios every quarter, every 6 months, every 12 months. It really depends on how the market is performing. But for us, when it comes to reviewing portfolios with investors, we look at multiple exit options. It could be a sale, it could be potentially a hold, but typically what we find to be the most popular strategy of our investors is that what we call like a refinance, an equity release.
Yeah.
Over a 5-year, 10-year period, and we detail this in all our cash flows we send out. But what we find is, a combination of the net monthly cash position, but more importantly, the capital growth we see over a 5 to 10-year period. What that accumulates for the investors is what we call kind of, that return on investment, that equity on top of their initial investment. So then obviously what we encourage the clients to do is sit down with their mortgage broker and look at those refinancing options, because what you can tend to do is of that equity that's been generated over a 5-year, 10-year period is you can strip out anything between 60 to 70% equity from that return on investment, use that equity that's been stripped out as almost a deposit on property number 2, property number 3, and so on and so forth. And for us, that is kind of the method behind building a successful portfolio, is not putting your hand back in your pocket, but allowing your initial asset to grow, refinancing, using that equity to then play your deposit on property number 2. And that's where we see the success stories building out, where people aren't impulsive, rash. In times like this where there is potential conflict going on, is be patient, allow the market to evolve, and then analyze the smart opportunities, the smart positions, and then that's where we start to see the real value. So for us, we will, if people want to get in and out in the UK in 12 months, it's not the right market for that. That's where you look at your more volatile markets, such as the UAE as an example, where there's potential massive reward, but also a lot of risk involved. If people are patient, have more of a conservative nature, want a stable, regulated market, where you can build a portfolio over time, the UK offers the perfect opportunity for that. And because obviously APR Global, and again, you guys will have partners, there's numerous lenders out there that provide the right advice with the right guidance and the right strategy in place. People can really take advantage of what the UK can offer. But for us, the smart play is really that equity release, the refinance, and use that equity that's being grown through capital growth, through your dividends, and use that as your deposit on, building up that multi-unit portfolio.
Excellent. Thank you very much for that, Alex.
My pleasure.
So as we shift from the property side to another extremely important side, how to keep us out of trouble with His Majesty, Rakesh, I'll come over to you, because obviously when we're looking, sometimes we sit in the Middle East in this very low, almost virtually nil tax haven that we live in. We can often forget about the tax issues that we have in the rest of the world, and particularly here for us today in the UK. So Rakesh, if you could take us on to your expertise and different things that you want to discuss today.
Brilliant. Thank you again, Alex. Great presentation. And Alexander and Jeffrey, great. Appreciate the opportunity. Perhaps you can turn to my slides and we can go through them. Obviously, it's harder and not as exciting as buying property because tax is one of those detailed ones where we've got to perhaps look at things in a bit of a deeper dive. So, Alex, if you could share my presentation. While that's carrying on, obviously to use the time well on this webinar, I'll crack on the first slide, tell you a bit about me. I'm a chartered accountant, DUA, a regulated firm with the ICAW, and obviously all tax planning requires fact finding, and of course a disclaimer that the legislation is only at a point in time. What you really want is somebody to take an interest in you, understand your background, and quite rightly, Alex on his presentation touched about long-term and intentions and what you're doing with the asset. So we're an award-winning healthcare and advisory firm, and we also have part of an international alliance, so we can help you with any jurisdiction issues that you have locally. And I think it's really important to look at not only UK reporting, but also look at your local reporting and get a seamless transition. But there's lots going on in the property tax market in the UK, and we need to be aware. So if we then turn to the next screen, that'd be great. The next slide, please. So one of the things also that probably separates us is our approach. So we've grown organically as a company because we have a number of qualified accountants. So everybody you interact with at the firm, and especially those given the fact you're going to be in property, both property managers are hugely qualified. And again, we have expertise to technical tax consultants to the nuances that happen in property. But right now, let's just talk about some of the issues. We need to understand you're getting involved in the UK. What's your intention? Is it long term? We're going to touch on various, positions that you can go in. What type of property you're looking at. Are you just putting your toe in the market, or are you actually building multiple units or trying to build an investment portfolio? So we do that. What's your structure? Are you an individual? What's your structure in your jurisdiction? Have you got any other entities, corporate wrappers, potentially trusts? If the trusts are there, what jurisdiction are they in as well? And again, as Alex says, because of the way stamp duty in particular is, loaded as an acquisition cost, it's not the cheapest place to do and get an immediate return. For that, there are costs to buying, the lawyers, getting the right structures, advice. So really, you need to quite seriously look at, are you doing this for mid and long term? And what is, the benefits that Alex said around that would be you're building consistent performance rather than spectacular performance, which is in there. And again, do you have an exit in mind? When we look at tax, we've got to look at income tax, capital gains tax, stamp duty, potentially if it's not residential, VAT, because that would work on there, or especially if you're buying commercial, which then goes down to the property, Or if, for example, you're becoming a developer, how can you look at structuring it to claim back any VAT costs? And again, there are, like in many jurisdictions, the type of where you're approaching. Are you an individual? Are you a partnership? There is a concept of LLP, limited liability partnership. Is this going to be corporate structure? Are you going to set up SPVs, which simply everybody uses in property, but stands for special purpose vehicles? And how are you going to fund it? Are you sitting on a debt, a cash mountain, and therefore it's an easy fund? Or are you actually turning around saying, I need to borrow? And if you do borrow, will you get tax relief? Well, first of all, will you get the borrowing and at what rate? And then will you get tax relief? Otherwise, it would be very expensive because, you're going to have to pay UK tax, and therefore the interest deduction is a way of changing the complete numbers on your return on the investment. So it's something we have to consider. So if we move on to the next slide, please. A lot of people we see this in many jurisdictions, come to the UK, they quite like the fact there's less pollution, nice parks in central London to walk around, but really, they want to buy in the UK, and potentially one of the things is they want to buy through a company. That tends to be quite a popular route. But if they did buy through a limited company, they've got to consider if they're going to live in there, something called ATED, annual tax envelope dwelling. So properties above £500,000, this is going to be a real hit on you. It's like an annual tax charge. So again, you need to look at, is that the best structure to have a company, and what will be ATED if you're living there? We do obviously get a number of our overseas clients that will want to set up or a structure or buy so that their family or child can live in here. That's an interesting scenario, because here there is the fact of, inheritance tax, which means that, if you don't structure it, because it's a UK cited asset, there'll be inheritance tax. Potentially also you could think about trusts, which will give protection as well. And thirdly, you also want to think about principal private residence, which is a concept when you live in there and you have a gain, what happens on the tax on the gain. So all of these things come in. But remember, as we touched on, any time you buy and there's an overseas or a non-resident individual behind, or individuals behind it, your stamp duty rate has two effects. One is the 2% increase on the acquisition, and the other is if it's put in the company, there'll be again a company extra charge for having it in. So effectively, stamp duty, if not planned in or not planned properly, has an effect of 17% on the acquisition price, up to that. So you really need to get advice at every stage, from when you're thinking about, or when you found the property, to how you structure it, what will be the cost of acquisition, what will be the cost of compliance, what will be my interest if I do want to claim deductions, can I get those, what will be my ongoing costs. And again, as we go through this, you'll find that there's other compliance issues that have introduced from 6th of April 26. One of the things that you really need to look at is your long-term intention. You're here because you're here for the long term, and therefore you have to balance all these costs, balance all these tax charges, and look at it as a longer term asset. And a number of people will go in for different reasons. So we talked about people wanting to live in it. If we turn to the next slide, you may want to be an investor, which means that you're more interested in getting a yield. Alex touched on this, looking at the right things. Obviously, we don't give advice on that, but what we do look at is, what's your ROI? Does it stack up? Have you done your due diligence? Have you tax efficiently structured it? And as you'll see there, I just touched on it. If your rental income is over 50,000, you're subject to making tax digital. And that means that you have to do quarterly returns. There's a lot of compliance that's coming in from 6th of April 26, which the following year drops dramatically. So a lot of people will be brought into the net of making tax digital, which means quarterly returns. If you manage it, you've got a good agent, a good accountant, it's not a problem. It's information filed through software, but it's just something you have to be aware of for your reporting requirements. And again, one of the other things is if, for example, you are a individual buying or you've got a structure where you're a non-resident landlord, you have to register with HMRC. If you don't, what will end up happening is that you will end up getting 20% deducted. So if you want to get paid gross, then you have to almost say that you've been approved for self-reporting, which means you go register with HMRC. Again, if you have any trust owning property, you've got to think about the trust registration service as well and HMRC's requirements on this. So again, when you're looking at property, it seems like, okay, I'll fly over, I'll select a property, and then I'll go back. Yes, that's great, but your journey also needs to make sure you're compliant. You're thinking about long term, you think about exit, you're thinking about tax charges now, tax charges annually, and tax charges on the exit. That's why I'm in a job, because it's complicated. But the good news is we can help you. We do this all the time. So like anybody else, work with good advisors and take good advice. Maybe we can move to the next slide. Some people want to come in as corporate investors. Again, what structure do you set up in the UK? Have SPVs, have NOLCO, or do you end up owning the shares in perhaps one of your corporate wrappers abroad? What will happen on the tax deductibility if you loan money? And all these situations can affect the end result, because the idea would be well structured. And if you're somebody who's a big corporate investor, you want to get deduction against corporation tax for interest. So there are a couple of solutions around quoted Eurobonds and again deep discounted securities, but they all have conditions which you need to satisfy, and if you do, then you get the deduction. But again, it's something you need to understand and make sure you've got in your planning, based on, as you know, you progress your journey from maybe one unit to multiple units or big trophy assets or investments. You need to think about it, and you need to also plan for the exit on capital gains. You know, where will the capital gain be if you sell, and you know, who owns the shares, and potentially dividends if you pay dividends, because the UK has no withholding tax on dividends. But you need to understand that there will be tax payable on the corporation tax, and you've also got to look at double taxation treaty of any withholding tax, depending on when you make any payments to individuals regarding that situation. It is important to, you know, think about the tax at the start, because you need to plan for it, and that will affect your overall due diligence as to the return that you will get. And corporate investors need to think about that and manage their cash flow. We could turn to the next slide, possibly. Right, so some people like to come in, they don't want to just hold investments, they want to go into development. We do get that. I'm not going to spend too long on this because it's, of course, about residential market, but again, you can come in. As I think Alex touched on, there is a real shortage of housing. So, you know, if you can get early, happy to go on a journey, go through the planning cycles, identify the right properties, have the right funding in place, then potentially you can set up SPVs we touched on, perhaps do JVs with locals or manage it yourself. But again, you at that point, when you're developing, it's like a business. You've probably done a permanent establishment, so you have to think about it. There are ways to set up jurisdictions using jurisdictions like Jersey in your structure. Of course, it goes without saying you've got to buy well, because, you know, most people tell you they've made loads of money on selling property. Well, no, it's probably because they bought well and did good due diligence and made sure that they eliminated as many risks as possible. For example, in development, you know, you've got to make sure there's, you know, loads of conditions around the soil, planning, foundations, building regulations. I'm not a specialist in this area, but I am a specialist in telling you, working with loads of developers, there are unforeseen circumstances. But if you get it right, there's a huge need at the moment, I believe, in the UK for housing due to the shortage, which creates an opportunity. Again, we talked about, if you're funding such a thing, the interest deduction here will be even more important, because obviously you need to look at how you can get this. And then again, you know, trying to get corporation tax relief would be really important here. if you do own the shares and they're owned abroad, there is potentially an inheritance tax because the asset's not in the UK, the shares are owned abroad. There is an inheritance tax advantage. So again, bespoke planning, understanding your intentions, what structures are overseas and locally, looking at the flows of it and setting it up is something that should be right at the start of your journey, working with the right team and advisors. Perhaps you can go to the next slide, please, Alex. Thank you. We touched on VAT on property. You need to look at option to tax. You need to look at whether it's commercial property, then it will apply on acquisition. If it's, for example, you're buying and doing planning, commercial conversions to Resi, you need to think about VAT. If you're doing Resi and you're planning to sell, then you have to think about the cost of the contractor and any ways of dealing with the VAT and the long term, which all requires understanding the intention at the end and what your situation is. Again, with jurisdiction, you have to think about double taxation treaty based on the jurisdictions between where UK and where you are at the moment, and potentially where your structure is if you're in multi jurisdictions. And again, because you're obviously looking at ring fencing and protecting the asset and making sure that it's based in the UK and minimizing risk, then again, not only working with planners we talked about, we mustn't forget the people who get you the money, but we mustn't forget the lawyers whose job is to protect you. And again, the ring fencing, taking good advice, making sure you're buying, making sure where the asset sits, make sure where the lending sits, making sure that all due diligence has been done. It's really key in the whole situation. So if we turn to the final screen, what makes us go through this? Well, I think at the end of the day, we touched about the team. As part of our technical tax consultants, we have Gordon Fox, who's been tax partner for over 30 years. We have Suraj Patel, who's been also one of our technical tax consultants and has been doing it for over 10 years. So I think at the end of the day, we as a team can help you in your journey. What we try to do is understand, make sure you understand, make sure we understand the structure, make sure we also understand the appetite as to where you're growing one, growing multiple, how you're going to use the property, what type of property is, and work with you on this journey, because the end outcome, we just don't want you to invest. We want you to have a good investment. We want you to have good confidence. And the good thing about the UK is there is legislation, there is tax legislation, there is certainty if you do your homework, there is planning involved, there is the rule of law, and therefore that's why UK is very attractive to a number of investors, because if you do all your homework, you take a long-term view, then hopefully your and your family's wealth or your corporate wealth builds up and it's a successful outcome. That is our job as professionals, to work with you to create successful outcomes. Thank you.
Excellent. Thanks, Rakesh. I really appreciate that. So I guess the question I want to ask you, and you highlighted it a couple of times, which was excellent, about early planning, getting your ducks in a row, as part of that process. What sort of common mistakes that people make when it comes to their tax? Or sorry, let me be more specific. When it comes to investing in property in the UK, what are the common mistakes that people make that get themselves into a bit of difficulty that people should be avoiding, obviously?
Well, I think number one is that they haven't thought about, there's probably 4 or 5, Jeffrey, but to start off with, they haven't thought about all the costs involved. They haven't used the right lawyers, which means that don't understand the jurisdiction, done all their KYC, so there's delays on it, which causes frustration and therefore increased costs. They haven't looked at their annual compliance, and therefore either they're dilatory or it's an extra cost they hadn't budgeted. They then are very surprised when there's IHT and CGT implications on exit, and therefore they haven't thought about what does that mean to the investment. So I think the best investors we find, Jeffrey, are the ones that are inquisitive and ask questions, because actually through questions you learn, and when you learn, you then bespoke it to your situation. And I think that narrowing of the funnel of your questions is the secret sauce. And that's why we keep a manager on it, because at the end of the day, everybody's situation to a certain extent is slightly different. You can't, everyone's going to be boxed with the same 3 or 4 questions, but actually there's maybe 3 or 4 other questions, and it could be the children, they're looking at education, it could be it's a pure home, it could be no one really want to build wealth. So I think the biggest problems happen in tax because there's no deep dive in understanding at the start.
I appreciate that. And in full disclosure, you actually highlighted something I need to take care of. You mentioned IHT. I have a change in my personal situation. I need to update my will. You just reminded me of that to make sure that stuff gets taken care of, so that that my kids can, if something happens to their dad, that my kids are well protected. So some good advice as always, Rakesh. You're always great at doing that. I actually meant to say at the beginning before introducing you, the one thing I've always enjoyed about working with you particularly is you also think like a entrepreneur, right? There's much more than just being a tax professional and tax advisor, but you actually look at things on an entrepreneurial basis, and you find excellent solutions for people. So which is why we had you on today, obviously, because of your advice. And I think, frankly, speaking to my Alexander about Alex and Rakesh, I think these 2 gentlemen have got some great expertise, some excellent opportunities to invest in. Rakesh helping up on this output from Alex, Rakesh helping up on the structure side, and I know through both of them and others as well, we have some great contacts with the right solicitors, the right property managers, to make sure that to get back to one of Rakesh's points, that at the end of the day your ROI is protected, and that you maximize that ROI. So to the whole panel, Alex, Rakesh, thank you both very, very much for joining us today. Alexander, thank you for putting all this together. Thank you for the idea of society, frankly, and for your original vision that got us on this path. I look forward to staying in touch with everybody. In case anyone joined the call late, it has been recorded, and we'll make sure it gets sent out. And I wish you all the best for the weeks and days ahead. Take care, everyone. Thank you so much.
Thank you, guys.
Thank you.
Thank you.
Thank you.
Bye.
Bye.